The S&P 500 is up 7.6% year to date. That's through Friday, January 27th. A very strong start to the year. January generally has a up month, so that is typical. But in addition to that, the Fed has paused a little bit, or is behind pace as far as quantitative tightening. On a year-to-date basis, the Fed has only reduced its balance sheet by $37 billion. If it was on pace with what's promised, which is $95 billion a month, it would be closer to $70 billion reduction in the balance sheet. This is one of the reasons stocks could produce a recovery. This lack of liquidity drain is helping financial markets. The economy had a very strong fourth quarter, and we are in a position where there is a real possibility of a recession coming in 2023. Companies are basically in the midst of cutting back, prepping for a recession. That's almost a self-fulfilling prophecy. As they do layoffs and slow down their spending, that impacts the profitability and revenues for other companies and employees. So it's almost self-fulfilling at this point. It does look like we will have a recession sometime in the second half of this year. With that, you would expect earnings estimates to come down, and they have been coming down pretty quickly. The S&P will probably have down year-over-year earnings into 2023 versus 2022. And the stock market generally has a difficult time when that occurs. The other issue is the Federal Reserve is considering slowing down its pace, and it has slowed down its pace from the 75 basis points increases. They did 50 last time, and look like they're probably going to do 25 for the next couple at most, and they might pause earlier than that. Historically, the stock market has continued to go down in a recession even after the Fed pauses. So the Fed pausing is not really a green light for stocks to start a new bull market. What will start a new bull market is the bottoming of profitability and then the subsequent improvement. Since we are still at least 6 to 12 months away from the bottom in profitability, I think it's a little too early to start saying a bottom is in the market, even though we've had a nice little bear market rally. Looking at what the Fed's going to be doing from quantitative tightening, one would expect that quantitative tightening would accelerate and get back on pace here. The Fed does have some treasury bonds and notes that are maturing here over the next week that are pretty substantial in amount, close to $85 billion. So we would expect the Federal Reserve's balance sheet to move back toward being on track for quantitative tightening here over the next week, which will be a negative for the market. So bottom line, in my opinion, is stay cautious. That's what I'm doing for my own portfolio. Please remember, this is not investment advice. And take a look at our disclaimer on buildingbenjamins.com, where you can also sign up for text and emails.